Over the last trading day, we do see a lot of red across the market. In fact, when we look at the semiconductor industry alone, it is red and quite significantly. Today our focus on AMD. Now this is a company which right now isn't trading too far off the 52-week range, and if we look back as far as the last 6 months, it is down more than 20%. Now we do like this company. We want to understand what are the bullish indicators, what are some bearish things to consider, but also how undervalued is this company and should we consider buying. Now we notice Seeking Alpha and Wall Street have those buy ratings, with Quant giving this a hold, and we'll come back to some of these metrics shortly. But for those that missed it, they did report their earnings a few weeks ago, and as we can see, the reason why they did drop on the release is due to the fact that their forecast fails to impress, despite what they have shown through their numbers as some very strong AI growth. Now you might be surprised to see that they actually beat on terms of the expectations, and when we take a look at the numbers, we can see the EPS coming in line 92 versus 92, but the revenue, although was marginal, was still an increase nonetheless. And what we have said in terms of earnings, companies like AMD are trading at a severe premium, which we will come to show you, and therefore Wall Street themselves want to see the guidance lifted so that they can justify these premiums that these companies hold. In fact, when we take a look, their guidance for the fourth quarter was in line with what they expected, and that ultimately, maybe you believe that is an overreaction, did harm the share price at that point in time. Now, in terms of the actual numbers, it is 7.5 billion that they are anticipating, and we can see that would be an increase of around 22% when we compare it to the same quarter last year. Now, what's nice to see, their bottom line for this quarter that they did announce was up 771 million. That is a massive jump from the 229 that we saw a year ago. And for those that don't know, AMD is the second largest seller of GPUs, and as we all by now know, they're used to train and deploy large generative AI models. Now we have an article from a couple of weeks ago where we can now see that AMD are expected to lay off around 4% of their workforce. Now typically investors do see this as a bullish sign. They believe that the company is cutting that workforce because they see some efficiencies. They're essentially reducing their operating expenses, and therefore we will see an increase in their bottom line. Now going back to the company, just a few other things that we do want to make you aware of. Over the last year, yes, it has underperformed the S&P, up only 11%. That when you do zoom out, especially for those that are longer term shareholders, you would have massively outperformed. You'd be up more than 5,000%, although we do in fact notice their all-time highs do sit in 2024 at around $227. We also note the forward PE sits high at 40.95. We'll compare that to the sector median as well as some other comparative metrics. But when we take a look at the earnings, it is expected to come down. This company's EPS is likely to grow at a very rapid rate. Now we have an article from the Motley Fool just a few days ago which talks about 2 AI stocks that will set you up for life, and one of them they do believe is AMD, and they've highlighted this because they see this in terms of growth to that share price return having a lot more upside than Nvidia, which you could argue right now has in fact already been baked in for the large part. So in terms of what they believe for AMD, we can see that they have grown their revenue at a compounded annual growth rate of 17% just over the last 10 years, and it has been profitable over the last 5. Now we'll get to the detail in terms of the actual numericals, and we can also note it isn't as heavily exposed to the AI market as Nvidia, which is always a great sign when you do have companies that get their top line revenue from just purely one income stream or heavily weighted. There are some risks that are attached with that. And then when we get to some other points that they do talk about, their growth not only looking good, but also their guidance. As mentioned at the beginning of 2024, AMD predicted around 2 billion of revenue in the data centers for the full year. Now it's saying just something we've heard of not too long ago at the end of Q3. They have lifted that outlook to at least 5 billion, which is very, very strong. That is more than double what they anticipated at the beginning of this year. And another positive point that is mentioned here is that when they compare it to some of their competitors like Intel, who manufacture most of their own chips, we can note here that AMD outsources its productions to Taiwan Semiconductors, and we have noted that that is effectively helping to avoid the issues that we have seen with others around fabrication. Now moving forwards to what is expected over the next few years, they believe AMD will grow their top line by a compounded annual growth rate of 21% year on year, with the earnings per share to rise in the same time at a triple digit 103%. And they believe even with this 43 forward earnings, there is still a lot of room to run as the AI market grows, and maybe when they compare it to Nvidia, they don't believe that upside does quite match. And that is something that is reinforced from this article that we have here, and they believe that there are some growth opportunities in the AI chip market itself, as we do see a lot of companies ramping up their capex expending, especially from the Mag 7 that we have pointed out earlier. And they believe it is time to reconsider which stocks you are betting to profit moving forwards, as a lot has already been baked in to many of these AI stocks. AMD though, analysts do believe there is some strong opportunities that the market hasn't yet priced in. Now we're going to move on to the metrics, and the first one that we always like to highlight on this channel is the free cash flow. As always, earnings data is susceptible to manipulation by management through accounting, and therefore when we look at the free cash flow, we want to see consistent growth over the long term. Not something we get from a cyclical industry, but at the same time, it is good to note over the last few years it has turned positive, but also bear in mind over the last two it has started to decrease, and as we can note, that cyclicality continuing with a massive jump anticipated over the next 12 months to $3.80 per share. Sales growth nearly double digit every single year, as well as on a trailing 12 month. However, the more recent period, 2023, they did have that drop of 4% to their top line, and when we do zoom out over the last 10 years, more than 4 times growth to their top line. They have also been diluting your position as a shareholder. What we want to identify here are companies that return excess cash through those share buybacks. However, even though they've pretty much doubled from 2014 to the latest quarter, what we would say as a shareholder during this period, you really wouldn't have cared. The share price did massively outperform the S&P. ROIC, one of our favored metrics, 10% or more to give us faith management are able to effectively allocate their capital. Looking very inconsistent, this is probably one area that we would like to see them improve, especially over the shorter term, where we only get 2% on a trailing 12 month. And the same to be said for the margins. Remember, we want to see a minimum of 16%, as well as efficiencies, which means margins increasing over the longer term. Not something we quite see, but we are hoping moving forwards with their top line revenue increasing at a rapid rate, with the workforce that they have started to lay off, we will see that start to come and show into the numbers, notably the operating margin. Free cash flow margin, 5% or more is what we look at here for a threshold. Now they've hit that in 2023, but again, do just bear in mind the inconsistencies that are cropping up throughout the metrics. Net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Now this correlates to the balance sheet strength. We want below 1.5, which is what we get in fact from 2017. And what this identifies to us, that it wouldn't take the company one day to pay off all of their debt net of cash on hand, 0 on a trailing 12 month, as well as 0 anticipated over the next 12. So a very good balance sheet, definitely one criteria that we like to see in companies we do want to buy. Now we also want to let you know we have released our latest free weekly article where we highlight 2 beaten down stocks with over 30% upside. Now we drop one every single Monday morning for free into your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information as well as the upside that Wall Street themselves see over the next year. And on top of that, we will be releasing December's copy over the next few days. And another spreadsheet you can grab, recently released 29 undervalued dividend stocks with the most upside that Wall Street themselves see right now in the S&P 500. So click below, you can sign up and start reading straight away. We also want to highlight insider ownership, which sits around 0.65% right now, around 95 million worth of sales by these insiders over the last year. And we also noticed around 17 million just in the more recent quarter. Now we'll show you for transparency who these insiders are, but bear in mind that we don't incorporate this into our own analysis because we don't believe insider selling is a bearish signal. They sell for many reasons, personal or financial. Now we have the CEO on the 6th of November, so just a few weeks ago, selling around 80,000 worth of shares, netting herself $11.5 million. Again, you can see some other sales by members of the management team. In terms of institutions, well, around 71% ownership, 10.5 billion worth of sales over the last year. In the same time frame, nearly double the amount of buys, and we also notice in the more recent quarter, Q3, they have been buying more than they have been selling. So bear in mind, institutions do seem to be bullish. They are buying a lot of shares of AMD right now, but as always, do your own due diligence and never copy what insiders or what institutions do. Now, we also want to highlight some of their slides from their investor presentation. The first one, to make it clear, their revenue is up on a year-on-year basis, 18%. We do quite like to see that. Then we look at their margins, also up. This is the gross margin, revenue minus cost of sales. Remember, that is what we ultimately want to see. Revenue up, tick. Gross margin up, tick. However, the operating margin isn't something we did see, and therefore that isn't what we like. But as always, we do apply a margin of safety towards the end when we get to our own valuation process. Then we move on to the operating income, moving upwards. Again, great sign from companies. We do pretty much want to see the majority of these metrics increase. Ultimately, though, when we see costs, we do ideally want to see them reduce. EPS, whether you want to see on a GAAP basis or a non-GAAP basis, also moving in the right direction. And for those that want to see a little bit more detail or in a tabular format, when we look on a quarter by quarter basis, not something we've done just yet, so we can see revenue is up 17%. Their gross profit is up 1 percentage point. That is just from the previous quarter, so we do quite like to see that. And their operating margin on the previous quarter is up 6 percentage points as well, with their bottom line net income up triple digits. So it is moving in the right direction. Again, this is clearly what we want to see from a company that does have a lot of benefits from the artificial intelligence industry. And then we move on to their segments. Now, I do have to say, when we have covered Nvidia, they do lay this out in a much better format. But ultimately, the one thing that we want to highlight here today is that their net revenue from data centers is up 25% from the previous quarter, triple digits, 122 from the same quarter last year. But what we have noticed, they have started to reduce in terms of some of their other sectors, notably the gaming as well as the embedded stream. Nonetheless, though, overall their top line, as we can see, is still moving in the right direction. Then what do they expect for the next quarter? Well, a lot of revenue, 7.5 billion, and their margin still looking very strong around the 54% point. So that is good to see. We do believe they will beat, just given their historical performance, and that is something we will touch upon shortly. And here, if you want to see a quick summary, you can pause and just digest. Now, as we talked about their earnings, what we do notice over the next 4 quarters, they are expecting double-digit growth, every single one on a year-on-year basis. And we also like the fact 100% historical accuracy over the last 4 quarters. At a bare minimum, they have been in line. Now look at this, their earnings per share is expected to grow at a rapid rate over the next full year for their accounts, 5.14, which will ultimately lower their forward PE to 26.51. Now, when we move on to their income statement, we did already highlight their top line revenue. As we said, more than 4 times growth over the last 10 years. But what we didn't highlight was their bottom line net income. What story does it tell? Well, when we look at it firstly from this graphical format, we do note a lot of inconsistency, in fact decreasing from 2021. So again, these are considerations to have. It is when we even look just over the last few years in a decreasing format. Nonetheless, on a trailing 12 month, we are expecting some large growth. So that is positive, but ideally we want to see it following the top line revenue increasing in that similar trend. Again, just things that we do want to point out. Now, we already covered how strong their balance sheet is from the quick net debt to EBITDA, but let's look at it in a little bit more detail. We do the health check, total cash versus total debt, and we can see nice growth from their cash, which does mirror the top line revenue, 1 billion in 2014, 4.5 billion in the latest quarter, so more than 4 times growth. As always though, in the balance sheet, one number in isolation will not give anything away, which is why we compare it to their total debt numerically and directionally. Now, from a graphical format, very inconsistent, but what we do note when we look at it from a numerical format, 2.2 billion in 2014, pretty much the same over the last quarter, so their total debt hasn't really moved bar the year-on-year perspective, but we can also see cash is higher than their total debt, so as we reinforced earlier on, it wouldn't take AMD one day to pay off all of their debt net of cash on hand. We also want to flag their cash from operations just so you do understand from that perspective how it looks like, and we can see quite inconsistent over the period. In fact, they had negative 98 million cash from operations in 2014 on a trailing 12 month sitting around 2 billion. Now let's look at some of their gradings. How do they perform under this aspect? They get a C rating. Now remember, 40.95 on a PE non-GAAP. The sector median 25.27. That means if you are buying this company right now, you are paying a 62% premium, and that is mirrored, reflected no matter which valuation metric you use. Is it worth the premium? Well, that's what we're going to take a look at now. And under the growth grade, the answer seems to be yes, where they get an A. Year-on-year revenue, 10%, sector 4.4. Moving forward, double digit, 11.4, 5.6 from the sector. And one thing that really stands out from this company is the earnings per share expected of 42% over the next 3 to 5 years, much better than 15.4 of the sector median. So look, it may warrant a premium, but we will always use that margin of safety in the episode to understand how much should we be paying. We then get the profitability of a B+. Now gross margin pretty much in line, 52 versus 51. Bottom line looking a little bit better, 7.5 versus 3.6. Cash from operations though very strong over the last 12 months, as we just showed, 2.12 billion versus the sector of 97 million. Now, quick recap for this part of the analysis. Double buy from Seeking Alpha and Wall Street. Bear in mind for Wall Street, 4.39 at 4.5 would turn into a strong buy. Quant, do give this a hold. C on valuation, A on growth, B+ on profitability. Now, two more things before we do jump into the valuation. First one, comparing their performance against others in the semi space. Now, total return over the last year, it is up only 11%, and that is the worst performing. What we have noticed though, the industry as a whole has looked good over the last year. Over the last 5 years, the best performing up 246%, and over the last 10 years up more than 5,000%. Now that is a very good performance, but as always, past performance is not an indicator of the future, so they could perform a lot worse. In fact, they could also perform much better. Again, we just want to highlight here the performance against the S&P, underperformed over the last year, but over both the last 5 as well as the last 10 years, no surprises, AMD has massively outperformed. We do show this though, just because when we do look at individual stocks, you do need to have that element of faith that these companies will outperform, otherwise you should consider a low-cost ETF. Now our intrinsic value today, $189. We will show you how we got that through the DCF model, but if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are notified of these videos as they drop. Now DCF model, we will go through that. What we note here is the free cash flow growth year on year. Now negative 280, as we can see, has gone from negative to positive a few times. That is why we get that there. Now we've gone for a 30% growth rate moving forwards. As we can see, a low, medium and high. Based on the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we see, $189, indicating upside of 39%. Now remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, where it is for AMD or any others. Now we'll just show you for full transparency, for those that believe it should be lower, 25%, 142, indicating 4% upside, and for those that are a lot more bullish, 35%, $250, 84% upside. Now we have included a 42% here. This is due to the fact that Bloomberg last year said they believe this industry will grow at around 42% on a compounded annual growth rate year on year. And for those that just want to see that here, again 42%, 365, indicating more than a double at 169%. Now we'll take the median rate of 30% through. As always, we do use a margin of safety at 10% and we execute on this if it meets our golden criteria. Wide moat, strong financial metrics, good forward-looking data. If you believe that today will buy at $170, then we keep going till it's near the current trading price. And what we can in fact see in today's episode, not far off a 30%, it is straddling between 25 to 30% in terms of the MOS. Now, Wall Street themselves, they believe there's upside of 38% over the next year. Their price target, $188. So this could be a good stock to consider if you want some more exposure to semis, or in fact, if you are looking for a strong stock over the longer term. 25 to 30% MOS, 38% upside. Is this one you are looking to buy, maybe hold, or in fact you have recently sold? Give us your thoughts below, and if you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter below, and come and join us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.